David Keir from Dundas Global, welcome to the Growth Symposium.
Great, thank you, Drew.
Could you talk us through the manner in which Dundas Global builds portfolios or assesses companies?
Sure. I mean, for us, it's all about dividend growth. So we want to invest in sustainable dividend growth companies. So for us, it's all about finding these companies. So what are the big drivers of dividend growth? First thing is we need to invest in companies that can sustainably grow their revenue. That means selling more goods and services every year. Now, we want these companies to be profitable. So we want management to display good cost-cutting measures and see economies of scales to get profits greater than revenues, and also want to see the cash generation come through. The key thing then is taking that seat round the boardroom table. And this is where management have to decide how much they're going to pay out to investors in form of dividends, but at the same time, how much to retain, to reinvest in the business to drive tomorrow's growth. And we talk about this dividend growth flywheel. So we have the business operations and then this dividend decision. And we talk about reinvesting in the future. We're looking at three main buckets. So we're looking at research and development, CapEx, and mergers and acquisitions. So mergers and acquisitions are really investing in today. CapEx is really building capacity, investing in tomorrow, and R&D is really investing in the day after tomorrow.
We've seen capital growth dominate returns for the last 10 to 20 years. What's driven that? And is it time or is it positioned for dividends that dominate returns in the next decade?
Sure. So I think the most important thing to say about us is that we are the dividend growth manager that doesn't want dividends today. So we're actually investing in companies that we want this payout ratio to be around about 40%, which would be much lower than the index. So actually, we want less income today. Now, when we look at returns over the very long term, we break down our returns into three buckets. Break them down between dividend growth, which is a proxy for business growth, dividend yield, which is your income point, and then also valuation change. And in the short term, think about 1 year, valuation is important. But as we look over the longer term, 1 year, 10 years to 20 years, what we find is the fundamentals of companies, namely their growth, so business growth, becomes a dominant factor over time. And actually, if you look at it over 20-year period, dividend yield and dividend growth account for 94% of total return of equities, so 6% valuation, with dividend growth being the dominant factor. So we would say that over the long term, business fundamentals win through.
And how have rising bond yields and higher inflation impacted your portfolio or opportunities, if at all?
Sure. Well, I mean, if you look at our portfolio, 2022 would have been characterised by excellent company fundamentals, and we take all our company fundamentals from our dividend growth announcements or dividend announcements. And if you looked at 2022, our companies in local currency increased their dividend by 17% year on year. It's 15% in US dollars, and that's against a long run rate or 10 years about 11%. So company fundamentals strong. Dividend yield at 1.5%. The issue for us in 2022 was a valuation compression. So that was very much linked to bond yields, rising inflation, and actually our portfolio derated significantly over that period.
And you talk quite proudly about a low turnover approach. Why does that matter and why is it important?
Because we are long-term investors. So we think about that, the componentry of return that I talked about in terms of business fundamentals being important over the long term. That is why we're long-term holders, because short-term valuation is important, and that's not what we're about. We're trying to identify businesses that can sustainably grow their dividends over the long term. So portfolio turnover at the start of the fund, we thought we were more like 20%, but as the portfolio has matured, it's come down to 15% on average over the last 5 years, and actually last year it was as low as 8%.
And what's one of the most compelling ideas in the portfolio at the moment?
I think Lonza is a company that's really interesting at the moment. So Lonza is what we talk as a CDMO, so contract development manufacturing organization. So it makes the drugs for pharmaceutical companies. So it's benefiting from an increased aging population across the world using more pharmaceuticals. It's benefiting from trend to increased outsourcing, and it's benefiting from a trend from lots of new drug development coming on. So they do the traditional chemical synthetic drugs, but also the more new biological drugs. So benefiting from a whole wave of trends, and it's all about capacity. This reinvestment I talked about is CapEx and capacity, and they do it in conjunction with their customers. So it's a very de-risked thing. So good company, good growth ahead of it, and good dividend potential.
David Keir, thank you.
Thanks so much, Drew.